Hi, I'm Ben Kingsley, and we are in episode 2 of Talking Property Tax with Julia Hartman. Now, Talking Property Tax is an educational tax series led by Julia Hartman, who is one of Australia's leading tax experts when it comes to property investment taxation and personal tax matters. Now, Julie is the founder of the Band Tax Group of accounting practices across Australia, of which Empower Wealth Tax and Personal Accounting is a member. Julia is also our Chief Technical Tax Advisor, and I'm thrilled to be talking to Julia today in episode 2. Now, if you're new to this series, I would recommend you check out episode 1, where we talk about the top 5 tax planning rules for every property investor should know. So that is episode 1. So go out and check that out. In this episode 2, we're talking about getting your tax house in order in the lead up to 30 June. So we're going to be talking about personal tax contributions. We're going to be talking about your tax bookkeeping in terms of the hybrid work, home office and working from office, a little bit of tips around car and what we're going to be doing there, but we're going to come back for that. And also we're going to finish off with property. What do you need to do in terms of property investment before 30 June as well. So I just want to, very excited to be welcoming Julia back for episode 2. So thanks for joining us, Julia.
Thank you for having me back again, Ben.
So let's jump straight into it. The first one, which is, something close to me, is making your money work harder for you. And there's no better way in some respects than your superannuation. So let's talk about personal super contributions. So what can I do before 30 June that will give me an opportunity to potentially top up my super?
Well, assuming you're an employee, you've got it gets a bit complicated, but if you can put extra money into super, if your employer has already put 27,500 in there for you, there's nothing more you can do. But if there's a bit of a gap, then you take, let's say it was a $10,000 gap. So you take $10,000 of your wages or of your income, but let's say it was before tax wages. Then if you took it yourself, odds are you're going to have about 6,500 after tax that you put in your pocket to, maybe people like to pay down their mortgage at 2%. I don't get that, but anyway, that's what they tend to do. Instead, you take the whole 10,000 and you put it into super, then you're only going to get taxed 15 cents in the dollar on that, unless your income's over 250,000. But most people only 15 cents in the dollar on that. So you've got 8,500 working for you. And what's super done in the last few years? About 9%. It's all 7. I'll be conservative, say 7, compared to paying down your mortgage at 2 to 3%. But it gets complicated because you don't want to go over that 27,500 cap. You won't get a deduction for the money. If you go over it, it'll just go into your undeducted cap, assuming that you haven't already used that up. So it's not the end of the world, but because you don't get deduction for it, and you've got to wait until you're 65 or whatever, depending, before you get to use it. So you've got to find out how much your employers put in there. And that is the problem, because while they might say on your pay slip for the month of June, we're going to put another 1,000 into super for you, they might not put it in until July. And super, it's all about when the cash is received by the fund. And it's the same with you. You need to start working on this early in June to be sure, but you're really going to have to quiz your pay area to find out. Like, some employers put it in before the 30th of June if they want the tax deduction. Others, if their cash flow is short, wait until July. So you really need to check that out.
So Julia, what a lot of people miss around superannuation is that it's taxed at a different rate. So you were talking earlier about the benefits you get in terms of your money working harder for you. But if I've got a pay-as-you-go tax rate and I've got a scaled rate, effectively I put money into super at a 15% tax rate versus what I have to pay based on the income that I earn. So explain that to our community.
Okay, so if you're earning between 45,000 and 120,000, your tax rate's about 34.5 cents, including Medicare, but it does vary a little bit with the offset, but I won't go into that. Then between 120,000 and 180,000, the tax rate is 39 cents in the dollar with Medicare. And then once you go over the 180,000, it's 47 cents in the dollar.
Right. So what's important about that is effectively you can have half the tax rate if you're putting money in. So if you've had a good year, a good financial year all round, and you've got a bit of savings, you've got a bit of money in your offset account and so forth. Because what also people need to understand, Julia, is does it have to come from the pay office to start with, or can you make that contribution at a later date?
You can do it through the pay office, but the trouble is you might not have enough pay. If you want to put 10 grand in, it's too late. You mightn't have that much in unused pay. So you can do it yourself, and you get on to your super fund and you ask them for the BPay details, but you've got to be very careful what you say to them. They will have their own different terminology, but this is definitely a member contribution, not an employer contribution, a member contribution. And if you ask them that you want them to send out the form you need to complete to claim it as a tax deduction, they'll get it. They'll realise what sort of deduction. And you don't fill out that form until you do your tax return, because as long as the money's in there, then your accountant can say, oh, look, really, you're only in the 19 cents in the dollar tax bracket. Maybe we won't claim it. Maybe we will. Generally, we do anyway. So, but you don't have to fill out that form until you do your tax return, providing you fill it out before the following 30th of June. You have to get the money in there well and truly before that.
So, Julie, there's obviously a lot of terms and conditions and nuances when it comes to super. So what we were talking about there was the member contribution, and there is a cap of that 27,500. We also know that there's obviously some qualifications in around additional contributions for funds that are under $500,000. And then there's a further larger amount that you will be able to potentially add to your super, which is another variation again. So what's the advice here in terms of when we are talking about $110,000 a year? Can you explain what this $110,000 amount is in addition, or separate to the member contribution that we've just been talking about around that cap?
Yeah, this is another cap of the amount of money per year you can put into super. You can draw forward a couple of years if you need to put, say, 330,000 in, but you don't get a tax deduction for any of this. It's just a great way of putting money aside where you can get your 15 cents in the dollar on its earnings at least, whereas if you had it in your own name, you'd be paying more on its earnings. So, but it's also a nice safety net. If you do go over your 27,500, it'll just go into your undeductible cap. You won't get penalised. They won't kick the money back out, but you'll be at least still there in super, earnings getting taxed at 15 cents in the dollar. Okay,
so there's again, what we're talking about is tax deductible contribution, which is the member contribution. There's the compulsory super from the employee, and then there's also this amount that doesn't have a tax benefit attached to it, but it has a benefit in terms of building up the wealth inside your super. So I think the message from my point of view is there's a lot of moving parts in here. There's thresholds, and if you get those thresholds wrong, the penalties are the highest tax rate, or it's even higher than that, isn't it? There's a large, sort of fine that you get charged on tax. So there's a lot of different elements here. So what I'm advising people to do is talk to your accountant after you've got an amount from your superannuation provider. So is that the first step? Go to the superannuation company, get a sense of how much has been contributed, work out what your cap amount will be, closer to that 27,500, and then talk to your accountant about some tax planning before 30 June. Well, your accountant from the portal can find out how much your employer's contributed so far. What they can't do is work out what your employer's going to do over the next few weeks. Yes. So it's talk to your employer, find out whether they're going to put your guarantee in before or after the 30th of June. Then your accountant can work out the rest for you. But don't stress about it too much, because it won't get taxed at the maximum rate if you go over your 27,500 or anything like that, because assuming you haven't used your 110,000 cap, it'll just pop into there. Still a good outcome, just no tax deduction. Okay, so there's an opportunity before 30 June to put money into super and tax effectively, legally, in terms of what we're talking about here. So again, talk to your employee. Obviously, your accountant then has great access to getting your contribution balance as it stands before 30 June. Put those two numbers together. If there's a shortfall, you may want to add additionally to your superannuation as part of that story. But I think there's no doubt that it's a good reason to have a good conversation with your tax accountant in preparation for 30 June. So that's personal superannuation. There's always lots of moving parts in it, and that's why I love talking about it, because even I get confused in terms of what's in, what's out, and what's possible, what's not possible. All right, let's now turn our attentions to our tax bookkeeping in preparation for that. So we have seen this year during the pandemic, working from home has become a really part of the fabric of work. And so there are now lots of people working from home, and there's potential for tax deductions when it comes to the home office. So let's talk through, the classic case of home office claims, and then let's talk about how the ATO has potentially tried to make it easier. But what are some of the pitfalls there, Julia?
Oh, well, I think there you'd be referring to this 80 cents an hour that they're saying you can claim. It used to be 52 cents an hour, that's still there. So if you were working from home, you'd get 52 cents an hour to cover electricity and wear and tear on the office furniture, that sort of stuff. But you could still claim on top of that 52 cents an hour, your stationery, depreciation on your computer, your phone, your internet, depreciation on your printer, ink cartridges, all that sort of stuff. There was a lot of stuff over the top of that you could claim. Now, at 80 cents they've given you as a gift, apparently, but you don't get to claim your phone or anything. It's all in that 80 cents an hour. So the majority of the time I find I'm claiming 52 cents an hour because the person's using their mobile phone for work and all that sort of stuff. So it's no bargain. But the bottom line is your accountant can work that out. They can go, what you need to do now before the 30th of June is create a diary that they can work from. We need to know how many hours a week you spend in your home office. It doesn't now have to be a separate room. It can be everyone in the same room. We just need to know how many hours per week by a month-long diary for you to keep. They will allow you, like if you're permanently from home, you work 40-hour week, you submit a timesheet, obviously that sort of stuff is fine too. But most people end up working longer than that. They might do their 9 to 5, and sure as eggs, 2 hours before they go to bed, they're back on doing some things. So you'd be surprised. In fact, that's the thing with all this substantiation. Tends to, once you get people doing it, the claims go up. They're too generous with the ATO most of the time, despite what the ATO thinks of us.
So let's talk about the bookkeeping. So you mentioned there that it needs to be a month long. What is the critical information that I need to be recording inside there to ensure that I've done my bookkeeping correctly?
Righto. So for the home office, it's just how many hours you're in there. It's straightforward, not too much at all. But when it comes to claiming your phone, you have to apportion the calls between private and work use. So you need to put, in theory, T on a piece of paper for a month and go private businesses to tick, tick, tick every call you make.
Yep.
Very difficult
and
to get
and
anyone.
The duration of the calls. So in other words, if I'm on a monthly subscription on my phone, and that's say $80 a month, and I've got unlimited calls, am I then working out the call duration? And from that call duration, I'm then working out my blend of personal versus business?
No, fortunately, they're not that bad with you. And most people have a plan now that it's a flat fee regardless of how many calls you make. But what I find is people won't keep that piece of paper. So what I encourage clients to do is every year they come in to see us, they sit there with their phone and they tend to be fiddling with it because they're bored stiff. So I say, right, I want you to go through your recent calls, take a screenshot of a month's worth of recent calls, and I get them to email it to me, and I print it up and I put that in front of them and I say, right, against each call, put P or W for work or private. And then I keep it in the file for next year because obviously they're seeing me in the next financial year. So I can use that the following year. What I'm encouraging your viewers now to do is do it for this year, because by the time you see your account, it'll be too late. So while you're sitting there with this, do a screenshot of your last month's recent calls and write W&P, take it along to your account, and they'll be so impressed.
They will be so impressed. And can I use that for both years? Like, how many years can I use that for? Or is it just the 1 year? So each year it's...
Every year they've got to do it, which
every
is...
year there's a diary.
I make them do it every year while they're sitting there.
So I've got an idea. What about home internet before we start to talk about the power? I'm assuming that comes back to the time in the office spent, etc., that we'll talk about. So let's talk about home internet. What can I claim when it comes to, because obviously from working from home, I need the internet to be able to get my Teams meetings, my Zoom meetings, my email, etc. What am I able to claim from an internet point of view?
You can do one of those diaries, but that diary's got to include every member of your family because they're using the internet too. And really, if you've got Foxtel and you've got kids, forget it. It's just, that's one of the things where they've just set the bar too high to achieve.
So even though it might be again a fixed subscription per month at say $80 for high-speed internet or whatever, and you're working from home, you're saying that they are setting the bar so high that the amount that you can claim is almost minimal?
Well, the work involved in getting the claim, you try and get your kids to keep a diary for a month on how many hours they're on the internet. It's not going to happen. What you could consider doing is getting your employer to reimburse you for it. Because as long as that sort of thing, they see it's primarily used for work, they're pretty much going to get a deduction for it. So.
Yep. And let's then start talking about, so the diary, the timesheet that you're making for the days that you worked at home, is that then correlating to power bills, water, and those types of heating and those types of things as well? How does that all play out?
That's what we'd use for the 52 cents, because you still get all the other things with the 52 cents. We wouldn't bother trying the power bills, I don't think, on actual meterage. The 52 cents is quite generous in that regard.
And obviously the big change between what's happened with hybrid work compared to people that were working from home and setting their businesses up from home, is there any impact on those people for their principal place of residence, and mixing that use for business? Can we just sort of clear the air when it comes to that in terms of what the ATO believes is plausible?
Yeah, they've clearly stated that working from home won't qualify you to claim, because some people would like to claim part of their rent, wouldn't they? But there's a difference between costs that increase because you're there and costs, occupancy costs that are going to be there anyway. Once you start trying to claim occupancy costs, then your home is exposed to capital gains tax. Now, the average worker just wouldn't qualify for it. It'd be more the small business person that's seeing clients there and can't avoid it. Most people don't want it. So, yeah, from their point of view, that's why you can't claim your rates, because they're the same regardless of whether you're working from home or not. It's only the things that increase.
And so what is that example of that self-employed person who is seeing clients or is running their business out of that, who are renting, and it is a combination of personal use and business use? Are they able to put a case forward in regards to a portion of their rent?
Yeah, basically on a square metre basis, they'd be able to, as long as the rooms, whatever it is specifically set aside for the business, doesn't really have any private purpose, bit of signage, bit of seeing people there. And renting, great, because there's no capital gains tax consequences. But if it's their own home, it's not the end of the world, because as long as they, for at least half the time they owned the property, or 7.5 years, which is ever is the shortest period, as long as it was used in the business for that period of time, they'll get the CGT small business concessions on the portion of the capital gain that's not covered by their main residence exemption. And they're pretty generous concessions. Used correctly, you probably won't pay capital gains tax there either.
As well. So that's not a bad story for those people who are self-employed, whose intention is to also run their small business out of their home for a duration until they either get bigger or they sell the business or whatever that looks like. So that's some good advice. So coming back to how we might summarize this, there's the two treatments. There's the 52 cents treatment versus the 80-cent treatment. There's stationery and those other things. So it's best to make a judgment call on that once you have all of that bookkeeping and that information together as to which way to go and which one's going to be more beneficial. Is that the way in which you approach this?
Yeah, but it doesn't take me long to realise that the phone's going to tip you over. So, like I said, very rare we go for 80 cents. If their employer provides their phone, then I'm very interested.
All right, so Julia, let's move our attention now over to car claims. We are going to cover this in a more detailed episode 3, but I'm really just interested in just the bookkeeping piece, right? Because the reason why we wanted to just flag it now, we're recording this in early April, so it's just an important message. So I want to get those messages around what I should be recording, and then leave it at that, and then we'll take a deeper dive in the next episode when it comes to all the nuances. But take us through what you believe is the most important thing when it comes to car claims.
Well, obviously substantiation, receipts and that, but you've got to work out the portion of private to business use. So there's 2 ways you can do that. One is a logbook for 3 months, kept every 5 years. And that's all right. Don't worry that you haven't got 3 months left to do it. Just start it in this financial year. And the other one is a detailed reasonable estimate, but it only allows you to claim 5,000 Ks per car, per owner of the car. So obviously spouses should be swapping cars. And you get 72 cents a kilometre. So it's very attractive, that detailed reasonable estimate. So the logbook's pretty clear. You just put in the date of the journey, the speedo reading, the reason for the journey, who was the driver, that sort of stuff. Reason for the journey and the locations, which you've got to put on the description. And most of those books come with a bit of detail anyway. With the detailed reasonable estimate, to get your 5,000 Ks, you could take a month's diary, but you have to do it every year. You can't it doesn't last 5 years. Take a month's diary and say, yeah, this is what I'm doing regular, look at that routine. But then you might say, but hang on a minute, I went to Townsville the other day. So that's a bit extra on top of that. And that's what you're doing. You're making a reasonable estimate. You had your month, but the month didn't include that trip to Townsville. So we multiply the month by 12. We add in the trip to Townsville, all showing detail. You can't just go 5,000 Ks easy. Try and get it up to the 5,000 Ks, and then you just claim, you reduce it back down to the 5,000.
Now, technology is playing a bit of a role in this. So, Julia, question without notice, is there any sort of apps or, are you still using classic logbooks that you'd be able to get from the stationery supplier? What are people using these days? Is there any new technology that helps in terms of the bookkeeping?
Yeah, I believe there are. There's a lot of stuff out there, but I'm afraid I don't know about it, Ben. I'd say you do. Maybe you should answer that question.
No. Well, I'm not. I mean, I'm no longer a roving or on, in the car mortgage broker anymore. So I don't know what they were. I used to use the old classic, sort of yellow covered book that I used to have to write basically everything in. But I do know that there are some applications out there that are trying to record your travel. And that just makes life a little bit easier, because obviously the mobile phone is a moving GPS. So that should be able to also help some of those people if they're looking to remove some of that administrative effort in terms of that. But again, I'm sorry, I don't know what the names of these things are, but I have heard that they're out there. So look, we'll make sure that by episode 3, we'll see what's out there, and we'll report back to everyone, give you a reason to come back to watch episode 3 when we take a more detailed look at car claims. Because as Julia rightly points out, at 72 cents in the dollar, and with the cost of fuel and everything else, you do not want to miss out on those deductions, because they really are important. And it's not just, the actual fuel costs, running costs, maintenance costs, repairs costs, upkeep of the car, and then also other travel costs, which also may form part of your deductions, whether you're traveling for business or meal allowances or any of those other things that we've also got as part of that. So there's going to be more information that we'll share in the next episode on this matter, because it is we're starting to get into the nuances. And our goal, in Power Wealth Tax and Personal Accounting is to maximise the deductions, as is the team at Bantax. We love getting into the nitty gritty and trying to find those claims where they're legally permissible. And so that's ultimately what we're doing here. And if I can, before we go into the property side, one of the things that I've learned over my journey when it comes to taxation is not telling your accountant a broader story or a fuller story about your situation means that, if the inputs are weak, then the advice is limited. If the inputs are broad, then and your accountant can see the future with you in terms of what your intentions are, the advice that I then receive from that is far better. And I'll give you a perfect example. I mean, I remember many, many years ago when I first started investing in property, nobody told me about the benefits of an offset account. So here I'm thinking I'm a superstar in terms of paying down the mortgage on the first property that I own, which I always knew was going to be a future investment property. And all of a sudden I didn't see those benefits. So that is a classic case of I didn't mention anything, I didn't know anything. And you're also going to want your accountant to be asking you lots of questions to try and work out ways in which you can find those best opportunities. So the best accountants are the ones who are inquisitive and are detailed in their subject matter knowledge. And that's why we have Julie here, because she's elite at it. Just in those explanations so far, we've seen that we could have gone down rabbit warrens and there's other aspects that we need to understand. So we're obviously just giving very general factual information today. The more you get personalised with your accountant, the more tax work they can do for you and the more benefits you get out of that. So I think that's an important way to finish off that. Home claims and superannuation stuff. Let's now put our property investor hats on and let's start talking about property taxes, because there are a couple of things in here, Julia, that I see come up from time to time, and some are better than others when it comes to that. And the first one that I wanted to talk about was interest in advance. So just explain to our community what that means in regards to how do I claim interest in advance and why would I do it, and what are the risks and the rewards?
Right, so you're bringing tax deductions from a future year back into this year, which means you won't get to claim that next year. So this year, you might pay interest 12 months in advance. You can't pay it any more than 12 months in advance. You've got to make sure the bank understands it's interest in advance, that they charge you the interest. Otherwise, you're just ahead on your loan, so you won't get any deduction. And think about the overall strategy here. Now, this year, we're going to be in a relatively low tax bracket for most people because we've got all those low income tax offsets still. Apparently, for the next 2 years, we won't have them. Who knows? We've got an election coming up. So in theory, next year, you're going to be, and the year after, in a slightly, if your income remains the same otherwise, in a slightly higher tax bracket. And then come the 1st of July 2024, anyone between 45,000 and 200,000 in income, it's only going to pay 30 cents in the dollar tax. So I can imagine 30th of June 2024, a lot of people will be paying their interest in advance to get it back in this high tax year. But who knows what your other situation is. So obviously you'd pay interest a year in advance before you went on maternity leave if you weren't going to be paid, or you went on an overseas trip, because you know your income and your tax bracket's going to be lower the next year. You've got to, if you've got a big capital gain, you want to save that for the year you take your interest in advance, because you're only going to get to take it in advance once, and then you're 12 months ahead. Somewhere along the line, to get back to normal, you've got to have a year you can't claim any interest.
And I think that is the important observation that I've seen, again, back in my mortgage broking days. I had a couple of clients that every year we do an interest in advance. It's a fair bit of work. There's a lot of work. And then once you start, technically you can't stop unless, as you say, you're planning it for that tax year where there's a windfall. So that's the challenge for me in terms of I don't see a lot of people taking advantage of that anymore because of exactly that point. Unless they can be clever about their planning, unless they're closer to retirement, some of those things can potentially, like if you've got a large windfall that's coming because of a payout or a bonus or whatever that may look like, one of those things could help you for that year in terms of reducing your tax. But I think it's very specialised, and I'd be saying to a lot of people that it's not necessarily something that I would be jumping at. But that's not the only one that you can claim on interest in advance. What other things have you seen people explore the interest in advance option on, Julia?
Well, you could try and pay your rates or something in advance, but I mean, you'd still have to have a bill to pay and be very careful because your rates might already be 6 months in advance. You pay a year in advance if you could somehow do it, or insurance, maybe, that sort of stuff.
Body corporate, yep.
But if you paid 13 months in advance effectively, because the insurance still isn't due, I suppose a good example is it's June and you've already got your bill for August for the insurance and you pay it there. Or if you pay 12 months in advance and the 2 months that you're already in advance, you're 14 months in advance, and therefore you have to pro rata what you paid over the term. You don't even get the first 12 months.
So, I mean, the wash up of that is, we would say more broadly speaking, it's not something that would be for everyone, not even close for everyone. It would be more, a very low percentage of people could take advantage of this, and it would be a case by case scenario. And that's why you should be talking to your accountant about that in regards to what that looks like. So that sort of makes sense for me in regards to that. The other one that, as we close out this whole interest in advance, what about if you own a commercial property? And in that sort of commercial property, let's say your tenant says, I've had a great year and I now want a big profitable year and I want to pay you 12 months rent in advance. Tell us a little bit about the consequences there.
Well, generally, that's going to be income for you all in 1 year. That's when you might want to pay your interest in advance. But you can try and argue the Arthur Murray principle that, hang on a minute, if I might have to pay that back. I haven't earned it yet, and try not to include it. But generally, yeah, be alert and alarmed.
So in other words, if
money anyway, wouldn't you? It's still worth it.
If your tenant is, if you want it for cash flow and opportunity to grow your business, it may be worth it. But in other cases, it's like that might be a benefit to your tenant, but it's not necessarily a benefit for you if that means you're going to have greater profitability and a bigger tax bill. So that's why, again, it's case by case basis, which is important to there. All right, so I think we've covered off the interest in advance, and we're saying to most, it's probably, cautiously move forward and understand the consequences, not only for this financial year, but what it means into the future is probably our takeaways there. Now let's talk about repairs, improvements, replacements. This is the area where, again, if there's, we talk a lot about this in our business with all of our property investors, with our tax accountants around what constitutes a repair, what constitutes a replacement and an improvement. So let's take a deeper dive into that. So what are some of the things I should be thinking about before 30 June, Julia?
Right. Well, first of all, before you go doing anything, think about whether it's a repair, because you're only going to get a tax deduction if it is a repair. And that's very limited. Obviously, if you replace something in its entirety, then you haven't repaired anything. You've replaced it. So it's not going to be defined as a repair. You probably, generally things that you can replace in your entirety, like a stove or stuff like that, you're going to then have to depreciate it. And if you do that 30th of June, well, really, you're not going to get a terrible lot of depreciation this year anyway. So you'd be looking to spend your money possibly on something else if you're looking for a tax deduction. Now, the entirety can be the whole house, walls, roof, doors, that sort of stuff. So if you replace the roof with similar materials, then you could get that as a repair, even though it's the whole roof, because it needs the walls to hold it up. So it is a repair to the entirety. But strangely enough, and this sort of goes along on different cases and what the judge was feeling at the time, I think. So if you replace all the kitchen cupboards, you're not going to, that's a replacement in its entirety. It's not going to consider a repair. But if you took all the doors off and put new flash doors on and left the cupboards there, then you get a repair. But the overrider, I say, on all this that I'm suggesting is you can't improve it beyond the state it was in when you bought it. So if you've just bought the property, then these are all initial repairs, which are improvements as such, because it improved it beyond that state. And they're only going to get, if they're a stove, yes, you get your written off over 10 years or whatever. But if it's the kitchen cupboards, for example, you're only going to be able to write them off over 40 years because it's initial improvement.
And so that's a lower probability. I mean, inside the show notes, and we're going to mention to everyone that we'll, package up the show notes into a downloadable, so you'll be able to see these. And Julia's gone into some good detail here in terms of covering off what we've talked about in today's episode. You make a reference to, changing from a steel roof to a tiled roof as an example. I think you mentioned it there before. It's about, is that a repair or would that be classed as an improvement? And I think that's the defining thing, isn't it?
Yeah, well, that's a great example, the roof. So let's say you've got a steel roof and you replace it with some sort of metal deck type bond thing. Then that's the current modern equivalent of the old corrugated iron roof.
Yes.
Right. So yes, that's just a repair. But if you then replace it with tiles instead, that's an improvement, and you're not even going to get a deduction for what it would have cost you to put metal deck or something on there.
So this is, and again, and we've also got to remember that it's got to be invoiced and paid by 30 June to be claimable inside this financial year.
Yeah, it's got to be incurred. So you could try and argue that I've sent this email to the builder, I've told him to go ahead, I've given him a deposit, therefore I've incurred the debt. So you could pull it forward on that basis. The cash doesn't have to have changed hands. And this is very important if you're not going to rent it out the next year.
Yeah, well, tell us that little tip there, Julia, in terms of, yes, if you've got a renter in a property versus the next year, when the property may not be rented. Tell us a little bit about the consequences of that story.
Well, to be able to claim a repair, you have to have earned rental income in the year. So if your tenants move out in June, this is where you've got to really push the incurred bit if you're going to put it on the market in July. And as long as the learnt rent during the year and the damage relates to the period when you had tenants, you have no trouble claiming repairs you do in June and then put it on the market the next month or whatever.
Yeah. Now, I want to sort of drill into things like improvements versus repairs, so we can get the community to have some takeaways there. I've got carpet, and I remove that carpet, and I realise that there's nice floorboards under there, and I want to basically, sort of polish up those floorboards as a means to give the tenant, quiet enjoyment of the property. What happens there? Would that be classed as an improvement because effectively it's a different floor covering than what was existing?
Excellent question. So this is the classic of how it changes from one court case to the next. So in this particular case, that they ruled that it was a repair, not an improvement. The ripping up the carpet and polishing up the floorboards was a repair. Obviously, the carpet was plant and equipment, so you've already depreciated it, or you write off what's left, it's undepreciated. But the cost of doing up the floorboards was a repair. Yet, next thing you know, there's another ruling where they say the building has subsided and they propped it up again, and that was an improvement. And yet it had subsided in the time of ownership. So yeah, no guarantees here on anything, but at least you've got those two rulings to go by.
All right. So the other one that I'm normally also doing is I'm, sort of improving or repairing bathrooms. So if I've got cracked tiles in the floor of the bathroom and I'm sort of attempting to do a like for like replacement of those tiles, would that be classed as a repair or an improvement?
Yes, assuming, of course, they weren't cracked when you bought it, you should be able to get that repaired because the tiles can't be removed easily from the floor without damaging them. Obviously, the only way you're going to get them up is to break them. So therefore, their entirety is your whole building. So replacing a group of tiles is a repair.
But you also gave a great little clue in there as well about so long as they weren't in that condition when you bought the property. So a lot of people potentially buy these renovators delights and then automatically think that all of the improvements, I'm using that word, all of the repairs and improvements that they're doing are going to be deductible. Now, the answer to that is they're going to be deductible, but are they going to be constituted as a repair versus are they going to be constituted as something that will be an improvement that we depreciate over time?
Yeah, they're going to be caught over 40 years. So don't rush out and do those, will you?
So that is, again, it's all about then looking at each item as you're looking at it. So if the tiles were all cracked, even though they were, and it's not fit for living, all of the changes that you're making wouldn't constitute a repair. They'd constitute an improvement because it's the first time that you've owned that property as part of your tax claimability.
The only good thing is if it was your home and you cracked the tiles while it was your home, but you didn't repair it until it was a rental, then you get the deduction because you're not improving it beyond the state it was in when you bought it.
So that's why Julia is a lead at this stuff in terms of knowing all of the little correct ways in which we can pull all that together. So I want to now talk about sort of plant and equipment. So talk to me a little bit about sort of, costs of certain amounts and the treatments around some of those costs. I see $300 here in our show notes, and how we're able to potentially make some certain claims as immediate write-offs.
So your plant and equipment is things that can be removed from the property without damaging the property or the item too badly. So you've got your hot water system, stoves, carpets, believe it or not, are included in there, air conditioners, fans. So that's your plant and equipment. Now, you're allowed to write off immediately the cost of anything that's under $300, but there's conditions. First of all, if you say you've got a fan that's under $300, if you replace 2 fans, then you've got to add them together as part of a set. So you're over the $300 mark. But it's $300 per owner of the property. So if you've got 2 owners and you've bought 2 fans for $290, you will get a tax deduction for those.
So that would be instantly written off in that first year. You go on to sort of a same sort of thing. Another example we have in the show notes around a hot water system of $1,900. Again, if it's owned by 2 people, how would that work in regards to certain claims?
Well, it's still going to have to be depreciated, but at least it goes in the low value pool, which is for items under $1,000. So you get 18.75% in the first year, and then 37 cents in percent after that, all diminishing value.
Okay, so what we've got there is the low, what was it called? The low
value pool. Low value pool,
that's up to $1,000. And that means you can claim 18.7% in the 7.5%, and that's $1,000 item. So again, if there's 2 of you, then ultimately that's $2,000, and you're going to be able to get 18.75, and then the following year, 37.5 the following year. So that is going to be depreciated far quicker than what would be the 2.5 or the certain percentages. Now, this does lead into the schedule of items, because there are different claims for different items, aren't there, Julia?
Oh, yes. Well, yeah, air conditioners are a different rate. Those fans, I think you can write them off over 5 years, but air conditioners, you've got 10 or 12 years. So, yeah, different.
Carpets, curtains, or, floor coverings, all of those have a different schedule item there. And so it's very, very important that you obviously provide that information to your tax accountant so they can make the appropriate depreciation apportion to each of those items. But it just further highlights this whole idea that it is a little bit of a minefield when it comes to this type of area. So you really want to be talking to an accountant who specialises in property investment claims in terms of what's possible. And a quick phone call to your accountant to clarify or qualify something along those lines is going to be really helpful in terms of some of that tax planning that you do to 30 June. So, Julia, we've covered off on a lot of ground here. I want to remind everyone who's watching or listening to this recording that we'll have links to the show notes where you'll be able to download this information. We'll package this up into a nice downloadable as part of episode 2 of Talking Property Tax with yourself. What's coming next? Next episode is a deep dive into car and transport and travel deductions. That's also another big part. So we promise to get that out to you in the couple of weeks, giving you enough time before 30 June to make sure you've got your house in order there as well. So I want to thank you, Julia, for your time today, and look forward to catching up in a couple of weeks' time when we record episode 3. And thank you for sharing your knowledge with our community.
You're welcome, Ben. Thank you. It's been a pleasure.
So if you're interested in getting some tax advice on all of these areas, we'd be delighted here at Empower Wealth to have a chat with you about your tax affairs. We do offer no obligation free initial consultations where you can meet one of our tax advisors and talk about your tax affairs. Getting your tax affairs right is really important as part of your overall wealth creation strategy. So why not feel free to reach out to one of our team here and see if we can help you help yourself.